Hello and welcome to the 2016 Annual Halftime Report for Paulson Wealth Management. We're very happy to have all of you here today and look forward to sharing our perspective on today's markets. Before we get going, there's a couple of formalities that we need to run through. So here's a few disclosures I'd like to draw your attention to, and so I can keep the regulators and the attorneys happy. Nothing we talk about here today should be considered investment advice. Everyone's situation is different, and we only give advice to clients we know well in one-on-one meetings, not in a presentation such as this. So it's hard to believe more than half the year is already behind us. All told, it's been a very volatile first half with plenty of market headwinds that we need to address. I'm sure you'll all have questions about what might be in store for the second half of 2016 as well. Our goal today is to educate you on some of the factors we and the world's market strategists are watching. While it would be impossible for us to cover every factor that affects markets, we'll try to touch on what we think is the most relevant. While past performance provides no guarantee of future results, we can use what we do know to help guide our decision-making process when investing. So here's what we're going to talk about today. First of all, we're going to have a brief review of the first half of the year. Then we're going to talk about 5 factors that we're watching in kind of a fun way that we call fact or fiction. And then we're going to look more focused on the economy with are we heading for a recession right now? And then we'll finish up by talking about strategies that are applicable for today's volatile markets. So, to get us started, here's a snapshot of the S&P 500 performance for the first half of the year. This year got off to a rough start with fears about the economic slowdown in China combined with panic over plummeting oil prices. And this caused a short but severe pullback. You probably remember that markets experienced a correction last August, and it wasn't so surprising to see another tumble since many of the same headwinds continued to blow in 2016. Stocks regained some of the steam by the end of February and sold off just as investors were starting to breathe again. Markets freaked out over falling oil prices, global growth worries, and fears about an imminent recession. However, after reaching a low in mid-February, stocks experienced pretty steady growth until May. Then another volatile pattern set in. Jitters about the timing of the next interest rate hike by the Federal Reserve contributed to a lot of volatility. So markets tested new highs in mid-June and then gave in to fear after Britain voted to exit the European Union on June 23rd. Fortunately, investors shook off their nerves pretty quickly and rallied in the final trading days of the quarter. Will the Brexit come back to haunt us in the months to come? We'll talk about that later. All told, the S&P 500 gained 2.69% in the first 6 months of 2016. Though it's not a stellar performance, it's a pretty respectable return considering all the headwinds markets faced down this year. So now let's look at some 2016 forecasts. At the beginning of the year, we compiled the S&P 500 price targets of some of Wall Street's top analysts. So let's review those predictions and see how many have changed at the halfway mark. We can see that several analysts have lowered their price targets for the year, indicating they expect the headwinds for markets that they've experienced to continue to drag on performance for the year. The S&P 500 closed at 2,098 at the end of June, which put it close to the annual target for a couple of the analysts. Back at the beginning of the year, the average across all these analysts was 2,193. Accounting for new revisions, the average price target now is 2,125, reflecting the changing expectations for the year. Of course, we're not trying to foretell the future. We are in the probability game, not the prediction game. But nobody knows for sure what equities will do the second half of 2016. One thing that appears repeatedly in analyst forecasts is that sector and stock picks matter a lot. Even as the S&P 500 as a whole might decline, it's possible to find some individual success stories. That's why we work with all our clients to develop customized portfolio strategies, global in nature with many asset classes that help them pursue success irregardless of the market environment. So now, on to our next section, fact or fiction. My PowerPoint is slow here, sorry about that. So with all the turbulence and uncertainty this year, there are a lot of potential threats to watch. However, some of these threats have merit, while others are just a lot of smoke. So let's take a look at what could be fact and what might be fiction. So the first one, fact or fiction, we're out of the woods with Europe. Between Greece's debt worries last year, Britain's vote to exit the European Union, and Europe's general economic woes, headlines from across the Atlantic have taken up a lot of bandwidth. However, markets shrugged off the Greek debt crisis and Brexit fears. So that must mean we're out of the woods, right? Well, we think that's fiction. Greece's ongoing debt problems and Brexit are very likely to send us more headlines and more volatility through the rest of this year. Now, does that mean Europe's troubles are going to cause a crisis or end the bull market? You know, we can't say for sure, but we don't think that Europe's woes will tip us into a bear market. This chart shows us the effect of a number of historic market shocks on the S&P 500. I want to draw your attention to the events highlighted in bold. Let's start at the bottom. When terrorists bombed several trains in Madrid in March 2004, the S&P 500 dropped 1.5% that day and fell 2.9% in the days that followed. All told, it took 14 days to get to the bottom and another 20 days to regain the previous levels. In 2008, the Lehman Brothers bankruptcy shocked markets, causing the S&P 500 to drop 4.7% the first day and to tip over into a bear market. It lost 46% over the 176 days that followed, and it took markets more than 2 years to regain the lost ground. Another international shock was the Japanese tsunami, which caused a meltdown of the Fukushima nuclear reactor. That caused the S&P 500 to drop 0.6% the first day and a total of 3.6% when the extent of the damage became clear. Stocks took 6 days to reach bottom and 14 days to climb back up. The two most recent shocks both involved Europe and were almost exactly a year apart. On June 29, 2015, the S&P dropped 2.1% on a day when Greece voted not to accept the bailout conditions imposed by its creditors. Investors worried about whether Greece would have to leave the EU or would renege on debt repayments. There was a lot of political turmoil in Europe, and that caused plenty of uncertainty over here. On July 8th, the New York Stock Exchange experienced a technical glitch, which also contributed to the tumble. Overall, markets fell 2.6% in 10 days. This June, the S&P 500 dropped 3.6% in a single day after Britain voted to leave the EU. We don't yet know whether markets are done reacting, so we could see more volatility. However, though we see Europe as a headwind this year, we don't think market problems are enough to cause the end of the bull market. All right, number two, fact or fiction. The Federal Reserve raising interest rates will spell disaster for markets. We've seen a lot of headlines about this since the Fed hiked interest rates last December. So we say, again, fiction. We don't think that further rate hikes will bring about a bear market. We don't know for sure, of course. However, we can look at what's happened in the past for clues. This chart shows how the S&P 500 performed after the second rate hike, averaged across all previous Fed tightening cycles. So historically, the averages show that there's an initial phase, initial rise, some volatility and consolidation, and then a rally months later. On average, history shows that stocks do pretty well in the months following a second interest rate hike. Now, as always, past performance is no guarantee of the future. These are also averages which don't take into account the unique factors around this tightening cycle. However, a lot of the worries about the Fed tightening might come from two historical anomalies. A surprise interest rate increase in 1979 ushered in two back-to-back recessions and higher interest rates. Another hike in September 1987 preceded the Black Monday crash in October of that year. However, the situation this year is different. There aren't any surprises because the Fed has done a good job, some might say too good a job, of telegraphing every play in advance. We know exactly what the Fed is thinking because officials tell us every chance they get. So they seem to have learned their lesson well. However, we can't say for sure that stocks will respond according to historical averages. The past doesn't predict the future. One concern cited by many economists is the fact that the Fed is raising rates during what's known as a corporate profit recession. That's a period when corporate earnings growth is negative, and we'll talk about that in corporate profits more a bit later as well. Here's what I want you to take away from this. Every tightening cycle is different, and there are too many variables at play for us to say how this one will play out. Historical examples are useful to a point because they give us perspective. However, we still have to prepare for things to go differently. It's that uncertainty that makes investors nervous and causes volatility. So fact or fiction, a recession can't happen. Now, many of you expressed that you like this chart. It's kind of busy, but it's color-coded, and that is very helpful. We reviewed a chart like this in the first presentation, market presentation earlier this year. So we think that a recession can't happen is fiction. Recessions are normal parts of the economic cycle. We can't be in a recovery or economic expansion forever, and it wouldn't be surprising to see a recession in the next few years. The 20 speedometers you see on this slide are visual representations of what we call leading economic indicators. City National Rockdale put these together, and they're forward-looking and help us see what pressures will be acting on the economy and financial markets in the next 3 to 6 months. Green is positive for the economy. We would call a green indicator a tailwind that pushes economic growth along. Yellow is caution, and red is a headwind that acts as a brake on economic growth. So this data is from January this year. You can see that the board is almost completely green except for 3 yellow cautions from the political environment, global growth, and equity market valuations. The one red dial is from geopolitical risks. So now let's take a look at the same chart with all the data updated to June of 2016. So you can see that though most economic indicators are still showing growth, a few things have changed since January. The political environment has shifted into the red. This is likely because of concerns about the upcoming elections. Geopolitical risks are still in the red due to concerns about what might happen overseas. And corporate profits are also now a yellow caution. We'll discuss some of these risks shortly and show you how we're preparing our clients for a possible recession. Fact or fiction. If there is a recession, it will trigger a massive market correction. So this one might be another fiction. Recessions aren't always calamities. The recession that began in 2007 was especially bad for markets because of a combination of economic, business, and financial events. However, recessions don't always trigger market catastrophes. This chart shows us periods of recession as dark bars and severity of bear markets in the S&P 500 in light bars. A bear market is defined as a sustained period of market decline during which at least stock prices at least lose 20% of their value. I'd like to point out a couple of things in this chart. One, recessions have occurred without being accompanied by bear markets. We can see several separate occasions when that happened since 1950. Bear markets have also occurred independently of recessions. This is usually because of external market shocks. It seems logical that a recession would trigger a serious bear market. Recessions usually lead to declines in corporate profits, which ought to push stock prices down. However, the link isn't that simple. A lot of factors influence stock prices. Factors such as inflation, interest rates, investor sentiment, and market shocks all influence stock prices. Next slide, please. So, if a recession happens, what can we expect from markets? This table shows us the S&P 500 performance before, during, and after an official recession. Take a look at the third column from the left. The first surprise is that in many cases, the stock market was actually up during the months the recession lasted. This tells us that the link between recessions and bear markets isn't tight. Over the 9 recessions on this table, S&P total returns were positive for 4 of them. Part of the reason might be because the stock market is a leading indicator and is always forward-looking. That's one of the many reasons why trying to time markets when you think a recession might be coming is a terrible idea. Though the past can't predict the future, we can look at it for hints. Each market and economic cycle is different, making handicapping it in advance impossible. What we're going to do here is make some educated assumptions about how markets could be affected in the next recession. The one thing we do know for sure is that recessions will happen in the future. So, fact or fiction? Will the presidential election in the U.S. have an effect on markets? Maybe. If you go looking, you'll find any number of theories about home prices, home price cycles, stock market cycles, zodiac cycles, all related to the 4-year presidential election cycle. We think that this is mostly fiction. While the results of the presidential election might affect your heart rate and peace of mind, the sitting president doesn't much affect markets. Excuse me for a second. This chart shows the average annual returns under Republican and Democratic presidential terms between 1961 and 2015. Are you surprised? While the numbers might suggest that a Democrat in the White House is overwhelmingly better for stock prices, reality isn't that cut and dry. There is no commander-in-chief of financial markets. In fact, the release of a new iPhone by Apple has a greater effect on overall S&P 500 performance than the president. Why? Apple is the largest company in the S&P 500 by market capitalization, and the iPhone is its most important product. Back in 2014, Apple and the sales of the iPhone drove 18% of the S&P 500's performance in that year. So the question is, what's going to happen in 2016 and 2017? This slide shows us how the S&P 500 fared under each presidential term since 1961, starting with JFK's presidency. Now, the previous slide showed that the S&P had done better under Democratic presidents, but you can see here that there's more to that story. The best performance was under President Gerald Ford, a Republican. However, the worst performance happened on George W. Bush's watch. What do you think? Would you say there's a lot more going on in the stock market than who is in the office? I'd say so. Now, I want to point out that though presidents might not directly control markets, they do hold a lot of power in terms of legislation, politics, and getting things done in Washington. Each candidate has a platform, and the decisions that president makes in office could have a big impact on your financial bottom line. However, there's a big difference between what a presidential candidate says during the election and what actually makes it through the legislative process. Markets hate uncertainty, and the election this year might very well cause some volatility. Depending on which party ends up controlling the White House and Congress, a lot could happen or not happen legislatively that could affect certain sectors and markets overall. We and the world's analysts will be closely watching the election to see how the results could affect our client portfolios, and we will keep you informed. So let's move to our next point. A big question on many investors' minds is this: are we headed for a recession? And it's an excellent question. We're in the 7th year of an economic recovery and expansion, and we know that a recession has to come sometime. Could it be this year? Maybe, but it doesn't seem likely. Could it come within the next couple of years? That seems like a stronger possibility to us. On the next few slides, I'm going to show you some of the evidence for and against a recession so you can see the same information we and other strategists are watching. The first point I want to make is that predicting a recession is very, very difficult. Lots of data has to be analyzed, and it's always a backward-looking process. You might have heard that recession is 2 consecutive negative quarters of GDP growth, but that's not an officially accepted definition. Officially, an economic recession is defined as a, quote, significant decline in economic activity spread across the economy lasting more than a few months, normally visible in real GDP, real income, employment, industrial production, and wholesale retail sales. So the government scorekeeper for recessions is the National Bureau of Economic Research, and economists there usually don't formally announce a recession until months after the recession actually begins. For example, the Great Recession that began in December of 2007 wasn't officially called a recession until December of 2008. That's a whole year later and just a few months before the recession actually ended. The previous recession began in March 2001 and wasn't called until November of that year. That's the same month it officially ended. So why is this? It's because all the data that goes into calculating GDP growth and other indicators isn't completely available until months later. The Bureau of Economic Research has to be very sure of the data before it makes any kind of official assessment. So even if we enter a recession, the official call won't come until months later. That doesn't mean that any expert with a pulse won't try to predict one in advance, and some people think you can predict a recession by looking at stock market behavior. There's a great quote by Nobel economist Paulson that says, "The stock market has forecast 9 of the last 5 recessions." However, we can look at the same data economists look at and make some educated guesses. So let's look at how long is an expansion supposed to last anyway? The official data on recessions and expansions going all the way back to 1854, and according to their research, since 1945, we've had 11 complete economic cycles and are in an economic expansion that began in June of 2009. Since 1945, the average expansion has lasted 58.4 months, or about 4 years and 10 months. That puts the length of our current expansion well above the average. However, I want to caution you against thinking we're due, quote unquote, for a recession. Much like bull markets, economic expansions don't just die of old age. Something has to cause that recession. I also want to point out that the last 3 economic expansions also blew past those averages. Now, the expansion that began in November of 1982 and ended in July of 1990 lasted 92 months. The recovery that began in March 1991 lasted over a decade and ended in March 2001. The recovery that began in November of 2001 lasted 73 months before ending in December of 2007. Now, we can never use the past to predict the future, but those increased lengths of expansions do seem to indicate that the economy is growing more stable over time. However, the fact that the current economic expansion has lasted longer than average could be a mark in the pro-recession column. I said could be, doesn't necessarily mean that it is. So how long might we have before the next recession hits? Well, that's the trillion-dollar question. One thing that history tells us is that recessions often follow interest rate hikes. Now, we don't know that there's a cause-effect relationship there because every interest rate tightening cycle is different. However, we can look at past cycles for clues. And here's what we know from data collected by Deutsche Bank. The average tightening cycle lasts 22 months between the first and last hike. The average amount of time between the first rate hike and a recession is 41 months. The Federal Reserve raised interest rates in December of 2015. Does that mean we're guaranteed to see a recession sometime in the next 30 months or so? Definitely not. The past doesn't predict the future. However, there are some unique factors at play during this cycle that make forecasting even more difficult. One, this economic expansion has been unusually moderate and not characterized by standout growth. According to Deutsche Bank, out of 118 rate hikes since 1950, only 2 have happened with nominal year-over-year GDP growth below 4.5%. 2, the Fed has trillions of dollars on its balance sheet already that need to be reversed, and they might be reluctant to engage in more quantitative easing if we do see recessionary pressures. 3, we're in a corporate earnings recession, and the U.S. companies are already struggling with weak demand. 4, the Fed is moving very cautiously in raising rates. They're looking at the same data we are and are telling us over and over again that they want to move cautiously to protect economic growth. Again, I want to emphasize that we're not saying there's a direct relationship between interest rate hikes and recessions. It's a complex relationship, and each tightening cycle is different. In our current rate tightening cycle, we know that the Fed is anxious to begin raising rates so that they can lower them again if necessary to fight off market shocks, economic problems, and higher inflation. With rates so close to zero, the Fed doesn't have many bullets left in the gun to fight downside risks. and that's a key concern for them. Another headwind for the economy is the weak state of corporate earnings. We mentioned earlier that the Federal Reserve might be taking a risk raising interest rates while we're still in a corporate profit recession. This chart shows us earnings per share growth for the S&P 500, which measures how much corporate profits have grown in a given quarter per share of stock. Starting in the first quarter of 2015, we can see that earnings growth turned negative, meaning overall S&P 500 companies saw their profits shrink from a year earlier. Quarter 3 and 4 of 2015 were especially rocky for earnings, with overall S&P earnings down about 14.5% and 15.5% respectively. For the second quarter of 2016, overall S&P earnings are forecast to be down 5.3% from a year earlier. If earnings are down, it'll be the fifth straight quarter of negative growth for the first time since the period between the third quarter of 2008 and the third quarter of 2009. Do weak profits automatically mean an economic recession is coming? No, but it's something we and other strategists have to watch. Now let's keep in mind that these are overall numbers for the S&P 500. Each company has its own struggles and triumphs, and there have been plenty of sector and stock success stories over the last few years, and we expect to see more this year. According to one analysis, 4 S&P 500 sectors are projected to report positive earnings growth in the second quarter. We'll know once earnings season wraps up. Just needed to take a quick break there, sorry. Probably the biggest indicator we look at with respect to the economy is GDP. This chart shows in dark blue actual GDP growth in recent quarters. In light blue stripes, it shows GDP forecasts for the rest of the year. Data are from a group of over 60 economists surveyed by the Wall Street Journal every month. We can see that GDP growth tanked in the first quarter of 2016. The economy did the same thing in the first quarter of 2014. At that time, the economy actually shrank 0.9%. GDP growth also took a hit back in the first quarter of last year, growing 0.6%. However, we can see that for the whole of 2015, the economy still grew a respectable 2.4%. Clearly, the economy struggles in the first quarter of the year, at least in recent history. This year, the picture is complicated by a number of competing economic factors that we're going to show you in the next few slides. Despite that, economists are still projecting solid growth for the rest of the year. However, most of the same economists polled by the Wall Street Journal believe there is significant downside risk to their forecast. The chart to the right shows whether these economists think they could be wrong to the upside, meaning they're too pessimistic, neutral, or wrong to the downside. Over 75% think the risk is to the downside. That is to say, if they're wrong about economic growth, they're likely being too optimistic with their current forecast. So it's clear that professional economists see some of the same headwinds that we do. So is the labor market slowing down? Well, it might be. There is good news though. Since the economic recovery started, we've gained well more than 8.8 million jobs. Including the June job gains, we've gained nearly 15 million jobs. As of June, the headline unemployment rate stands at 4.9%. That's great because the labor market is a big supporter of economic growth. However, there are some signs the job gains might be slowing. May's numbers were well below expectations, and the rate of annual job growth has slowed down. That's to be expected, given how far along the economic recovery is in terms of how long we've been in recovery mode. One thing you might have heard experts talk about on the news is the labor force participation rate, which is simply the percentage of the total population that is either working or actively looking for work. You can see in the chart on the right that the line has been decreasing from a peak in 2007. The colored areas represent categories of people who have dropped out of the labor force. Many have aged out of the labor force and retired. Others have dropped out due to cyclical factors such as lack of job opportunities or lack of skills. The group labeled other might have been affected by more permanent structural changes in the economy. These might be people who worked in industries that have undergone shakeups and no longer have the same opportunities. Many of these people might also be taking on contract or part-time work that isn't counted accurately, and they would like to work full-time. Being able to accurately measure why people aren't working is important to policy. It's also important to employers who might be struggling to find qualified employees. Overall, it's clear that the labor market still has strength, but there might be limits to how much lower the unemployment rate gets because of these structural shifts in our economy. One positive indicator, we'd like to talk about those as well, that's been supporting economic growth this year is consumer spending. Consumer spending is a critical part of the U.S. economy. Domestic spending accounts for about 70% of the economic growth in this country. We like to look at multiple indicators to tell us how Americans are spending. One of the ways we gauge how Americans are spending is by taking a look at their discretionary spending on big-ticket items such as cars. Taking a look at the chart on the left, we see that light vehicle sales have been on a tear since 2009 when Americans recovered their spending power after the recession. The historical average is 15.5 million vehicles purchased per year. As of June, we're at an annual rate of 16.6 million. But the numbers are down slightly from a peak in the fall of 2015. So what does this information tell us? Americans are still making major purchases, and that's great news for the economy. Another gauge of consumer spending is personal consumption, which measures how much U.S. households spend on goods and services each month. The chart on the right shows us the change in personal consumption from a year ago since May 2006, and it's been adjusted for inflation. We can see that spending dipped into the negative during the last recession, indicated in gray on the chart. Since the recession ended, spending grew rapidly, expanded, and then contracted over the last few years. In May of this year, which is the last month with available data, spending was up 2.7% from May of 2015. Personal income is also up. Since the first quarter of 2013, disposable personal income after inflation has been on a steady upward trajectory. Both these trends support continued economic growth. Another positive forward-looking indicator is consumer sentiment. Essentially, this is a survey that asks regular Americans how they feel about the economy and their financial prospects. It's an important indicator because sentiment has a strong relationship with consumer spending, which drives 2/3 of economic growth. Sentiment can also be tied to market performance. If you take a look at this chart here, you'll see that the dots show highs and lows in consumer sentiment. Below that is the subsequent 12-month return of the S&P 500. Note that sometimes when consumer sentiment is high, stocks performed badly afterwards. That's what happened in January of 2000 and again in January 2007. In January of last year, sentiment peaked at levels not seen since January 2007. That made analysts worry that a major correction was imminent. What happened? We had a choppy, flat year for stocks. Why is that? Well, it's complicated. There are not simple cause and effect relationships between these indicators, but high levels of consumer sentiment can be a sign of irrational investor exuberance when prices are bid up to unsustainable levels. Historically, recessions sometimes follow periods of high consumer sentiment. We see those recessionary periods on this chart as vertical shaded areas. Is that always the case? No. We can see it wasn't the case in 1977, 84, or 2004, but it did happen in 1972, 2000, and 2007. As you can see on the far right, recent volatility and economic concerns have taken a toll on sentiment. In June, sentiment was 93.5, down from the optimistic high reached last January. It's still above historic averages, though meaning Americans are still feeling pretty good about the economy. All told, we put this data point in our positive column for the economy. So let's summarize what we told you so far about a potential recession. Predicting recession is hard, and we won't have an official ruling on it until months after the fact. On the negative side, the economic expansion is getting old. The Federal Reserve is raising interest rates. Corporate profits are weak. These trends could push us towards a recession. On the positive side, GDP growth is moderate and still forecast to remain so. The labor market is strong, but it might be slowing. We also have consumer spending and consumer sentiment that remain strong. These trends support continued economic growth. All told, there are definitely some economic headwinds. The experts don't believe we're at serious risk of a recession within the next year. This chart shows the results of a poll of Wall Street Journal economists over the last 9 months. As you can see, economists are more worried about a recession than they were in October. On average, They put the odds of seeing us in a recession at 21%. However, economists have laid odds on a recession before. Back in January 2012, recession odds in the same survey stood at 19%, and there was no recession then. We will continue to monitor all the factors we've discussed here, and we'll keep you informed as we usually do. So, we've reviewed the first half of the year, shared some of the indicators we're watching this year, and talked about the probability of a recession. Now let's close by talking about some strategies for dealing with volatility in bear markets. So as always, there are plenty of excuses to panic. The most important strategy of all is this: ignore media headlines. Here are a few headlines we pulled from the last 6 months. Here comes the biggest stock market crash in a generation. Donor Paulson says Trump would cause a depression. U.S. stocks cleanest filthy shirt in the grotesque hamper. The end is coming, says Ron Paul. 80% stock market crash to strike in 2016, economist warns. How can you keep your cool when you read that in the morning paper? There are always going to be headlines telling you to panic. So news outlets need headlines to pull in viewers. One of the ways they do that is by turning minor events into breaking news panics. This chart shows S&P 500 price performance between 2004 and 2014 and CNBC viewership over the same period. Do you see a correlation? Notice how viewership spiked as the stock market fell during the financial crisis. It wasn't because they were telling everyone to keep calm and carry on. People tend to focus on negative information and turn to the media in times of crisis. That's not a great way to keep your cool. Don't listen to the talking heads. Tune out the noise and let us filter through the headlines and keep you up to date on what's going on. We also accept that volatility and pullbacks are normal in financial markets. This chart shows the annual return of the S&P 500 since 1980 at the top of each column, rounded up or down. The red numbers below show the biggest drop in the S&P 500 experienced during that same year. Some of these dips happened over days, some occurred over weeks and months. Moving along the chart, we can see something interesting. Even in positive years, stocks experience serious dips that might have made investors extremely nervous. However, history shows that these drops are typical. In fact, the S&P 500 has experienced average intra-year declines of 14.2% since 1980. Despite those declines, annual returns were still positive in 27 out of 36 years. So, what does that tell us? Even when we see small retracements, it's not a big deal. Don't panic. Does that mean markets will always end positive after a correction? No, we'll have down years. No one can predict where markets are going. Not me, not you, and certainly no one who gets paid to attract eyeballs to television shows. Instead of trying to predict exactly what markets are doing, we step back, take a look at what the analysts have to say and what probabilities tell us, and make prudent decisions. We stay flexible and look for opportunities amidst the volatility. Our focus is on the goals that we set for you before we start investing. Questions like, has anything changed in your financial picture? If we need to make prudent changes to your strategies, we will. However, we don't give in to knee-jerk reactions just because the markets are moving around. We also don't obsess over performance benchmarks. We use the S&P and other indices as standard performance measures and good examples to provide reference. However, we never are intending to replicate the S&P 500 performance because indices don't include fees, taxes, dividends, and other variables we have to consider in the real world. They also don't include the careful risk management that we use to help you manage what you've earned, to grow it and provide for the future. So this chart shows the hypothetical growth of a $100,000 investment between 1996 and the end of 2015. It also shows many of the emotions an investor might feel along the way. It includes euphoria when markets are high and surprise, nervous panic, and defeat when markets pull back. It's all normal and part of it being an equity investor. The investor who remained invested in this hypothetical illustration might have seen that investment grow to nearly $500,000. Investors who sold out during the lows would have missed out on the rallies that followed. Keep in mind that this is just a hypothetical illustration that doesn't include factors as taxes and fees. It's not meant to show the actual performance of any investment. It's just to provide color as to what we have to navigate as investors. I want to close with this. There are a lot of financial and economic uncertainties in today's world. While we often can't predict or prevent them, we can mitigate them by preparing in advance. Here are some of the top fears cited by retirees in a recent survey. 44% worry about future health care expenses. 44% worry about reductions in Social Security benefits. 41% worry about outliving their savings and investments. How prepared are retirees for retirement? While 54% have financial strategies in place, just 10% have formalized them into writing. Only 7% have prepared in advance for savings shortfalls or retiring sooner than expected. And 12% wish they had gotten financial advice sooner. Here's what I want you to take away from the slide. It's normal to be worried about the future. It's normal to wonder what retiring in volatile markets will be like. We can't control markets and we can't predict the future. However, what we can do is study data, stress test different scenarios, create a written financial plan for you with goals and your risk tolerance in mind, and put in place a plan and a portfolio that will help you pursue your retirement goals in many different market environments. If you're worried about a future in uncertain markets, please come talk to us and let us do the worrying for you. So thank you, everybody. That was the halftime report for Paulson Wealth Management. We hope you enjoyed it. If you have any questions or concerns or would like to get your own financial plan done, please give us a call at 630-517-2950 or go visit us on the web at www.paulsonwealth.com.